Welcome to Money Minds, where we unravel the mysteries of investing. Today, we're diving into the S&P 500 index. Have you ever wondered why most people should invest in this financial benchmark? This, ladies and gentlemen, is the enigma of the S&P 500, a financial marvel that has captivated investors worldwide. This powerful yet elusive index is more than just a collection of 500 large U.S. companies. It's a gauge of the overall U.S. stock market, reflection of the economy, and a beacon of investment potential. You've likely heard its name echoed across financial news channels, seen its figures quoted in economic reports, or felt its impact in your own investment portfolio. The S&P 500 has a magnetic pull, drawing in seasoned investors and novices alike. But why? What makes it such a popular choice among the vast array of investment options available? We won't give away the just yet. Instead, we invite you to join us on this journey of discovery. Stay with us as we unravel the secret behind the S&P 500 index's allure. So, what exactly is this S&P 500 index we're talking about? The S&P 500 index, or the Standard & Poor's 500 index, is a stock market index that measures the performance of roughly 500 of the largest companies listed on stock exchanges in the United States. It's like a barometer that gauges the overall health of the U.S. economy. Here's how it works. The S&P 500 index comprises 500 leading companies in leading industries of the U.S. economy, capturing approximately 80% coverage of available market capitalization. It's not just a simple list of the 500 largest companies by market value, though. Instead, it's a weighted index, which means that the companies with the largest market values have the most influence on the index's value. So, if a company with a large market value sees its stock price increase, it will have a bigger effect on the value of the S&P 500 index than a smaller company in the same situation. This means that the movements of the S&P 500 index can give us a pretty good idea of how the largest companies in the U.S. are performing, which in turn gives us insight into the health of the U.S. economy as a whole. The index is managed by the S&P Dow Jones Indices, a joint venture majority owned by S&P Global. Companies are chosen for the index primarily by liquidity, market size, and industry group representation. The S&P 500 index is one of the most widely quoted American indexes because it represents the largest publicly traded corporations in the U.S. Now, you might be wondering why it's called the S&P 500. The S&P stands for Standard & Poor's, the name of the company that first created the index. The 500 inches refers to the number of companies included in the index. The S&P 500 index is not just a measure of the U.S. economy's health. It's also a benchmark against which financial and investment professionals compare their investment returns. It's a tool that helps investors understand market trends and make informed decisions. Now that you know what the S&P 500 index is, let's dive into why it's such a popular choice for investors. Ever wondered why the S&P 500 index is a favorite among investors? The S&P 500 index is like a superstar in the world of investing, and its popularity is not without reason. For starters, let's talk about diversification. The S&P 500 index is a collection of 500 of the largest companies listed on U.S. stock exchanges. This means investors are effectively spreading their investments across a wide array of sectors and industries, reducing the risk of having all their eggs in one basket. It's like having a slice of the entire U.S. economy in your portfolio. But there's more. The S&P 500 index is known for its low fees. You see, many S&P 500 index funds are passively managed. This means they don't require a team of analysts and fund managers to pick and choose stocks, which can be a costly affair. Instead, these funds simply aim to replicate the performance of the S&P 500 index. This passive approach translates to lower operating expenses, which means lower fees for investors. Now, let's talk about performance. The S&P 500 index has historically delivered strong returns. Since its inception in 1957, the index has averaged an annual return of around 10%. Now, that's no guarantee of future performance, of course, but it does illustrate the potential of this investment vehicle. Over the years, the S&P 500 index has proven to be a resilient performer, bouncing back from market downturns and reaching new heights. This resilience, combined with its diversification benefits and low fees, makes it a compelling choice for many investors. Keep in mind though that like any investment, the S&P 500 index is not without risks. It's subject to market volatility and the performance of the US economy. But for those who are looking for a long-term investment that offers a broad exposure to the US stock market, the S&P 500 index often stands out as a top choice. Sounds appealing, doesn't it? But wait, there's more to it than meets the eye. And so why should most people, maybe even you, consider investing in the S&P 500 index? Well, let's dive into the reasons. One of the primary reasons is that the S&P 500 index provides a simple way to gain broad exposure to the US stock market. Instead of handpicking individual stocks, which can be a daunting task even for experienced investors, investing in the S&P 500 index lets you own a small piece of the 500 largest companies in the US. Think of it as a smorgasbord of American capitalism. You're investing in a slice of the entire US economy, which includes sectors like technology, healthcare, finance, consumer goods, energy, and more. This diversified approach helps to spread the risk and can potentially provide more consistent returns over the long term. Speaking of long term, the S&P 500 index is an excellent vehicle for long-term investment. Why? Because over the long haul, the stock market has historically trended upwards. Despite short-term volatility and market downturns, the S&P 500 index has proven to be resilient, bouncing back and reaching new highs over the decades. Consider this, if you had invested in the S&P 500 index in the early 1980s, your investment would have grown exponentially, despite several market crashes and recessions along the way. That's the power of long-term investing and the compounding effect of returns. Now, let's talk about historical returns. The S&P 500 index has delivered an average annual return of approximately 10% since its inception in 1957. While past performance is not a guarantee of future results, this track record is pretty impressive. With a 10% average return, you could potentially double your investment approximately every 7 years thanks to the magic of compounding. Moreover, by investing in the S&P 500 index, you're not just betting on one company or one sector, you're essentially betting on the continued growth and innovation of American businesses. And let's face it, US companies have been at the forefront of global innovation and growth for the better part of the last century. So to sum it up, the S&P 500 index offers a relatively easy way to gain exposure to the US stock market. It's suitable for long-term investing, and it has a history of solid returns. It's like having an all-star team of American companies working for you. But remember, while the S&P 500 index offers many benefits, it's not without its risks. It's essential to understand that investing always involves risk, and you should carefully consider your financial situation and tolerance for risk before jumping in. After all, the value of investments can go down as well as up. But with a thoughtful approach and a long-term perspective, the S&P 500 index could be a valuable addition to your investment portfolio. While the S&P 500 index sounds like a golden goose, it's important to understand the risks involved. Now let's get real. Investing in the S&P 500 index isn't a guaranteed path to wealth. Yes, the index has historically offered solid returns, but it's not without its share of risks. Let's delve into some of those risks now. First and foremost, the S&P 500 is subject to market volatility. This means the value of the index can fluctuate wildly in short periods of time due to economic factors, political events, and other unforeseen circumstances. If you've invested a significant amount of your savings into the S&P 500, these fluctuations can be unnerving and potentially damaging to your financial health. Secondly, while the S&P 500 is diversified, it's not immune to losses. The index represents a broad swath of the US economy, but it's still possible for a majority of the companies within the index to perform poorly at the same time. This happened during the financial crisis of 2008, when the S&P 500 lost about 50% of its value in less than 2 years. Thirdly, it's important to remember that past performance is not indicative of future results. Just because the S&P 500 has performed well in the past does not guarantee it will continue to do so in the future. Factors such as inflation, interest rates, and economic growth can all impact the performance of the index. Lastly, investing in the S&P 500 requires a long-term commitment. It's not a get-rich-quick scheme. You need to be prepared to weather the ups and downs of the market and stay invested for the long haul. This can require a strong stomach and a level of patience not everyone possesses. So, Is investing in the S&P 500 index right for you? Only you can answer that, but now you have the knowledge to make an informed decision. That's all we have for you today on the S&P 500 index. We hope you found this information useful and that it's given you a better understanding of what the S&P 500 index is, why it's popular, and the potential risks involved in investing in it. As with all investments, we strongly encourage you to do your own research and consider your financial situation and risk tolerance before diving in. If you found this video helpful, please don't forget to subscribe to our channel for more investment tips and insights. Remember, the best investment you can make is in yourself. Happy investing!